If you are tracking inventory in QuickBooks, from time to time you may need to make an inventory adjustment. Perhaps a piece of inventory got damaged and is no longer sellable, or perhaps you gave something out of inventory to someone as a sample, or perhaps a salesperson gave you a piece of inventory as a sample for you that now you're going to resell. Whatever the case may be, for those types of situations, you would need to make an inventory adjustment. So under the Plus New, we can choose Inventory Quantity Adjustment. With this screen, we will choose the date that we're making the adjustment. The inventory adjustment account is very, very important. Inventory shrinkage is an expense account. That would be what you would use in the case of loss or damage to an inventory item, so that you can claim that as an expense. If you give an inventory item to someone for marketing purposes, you would want to choose advertising and promotion, or advertising in this case. If a salesperson gives you some inventory just as samples, but now you're going to sell it, for that you would need to choose other income. What we do not choose in this one is inventory asset. That's a common mistake, but this form is attributing to inventory asset. If you choose inventory asset here, you have both put in and taken out dollar amounts to inventory asset. So that does not help you. It does increase or decrease the number of quantity on hand, but it will skew your reports as far as the dollars go. So make sure you choose the appropriate account here. Generally, inventory shrinkage, or other income if you've been given some inventory that you can sell, or advertising if you're giving away some inventory as a promotional. So choose the proper account there, and then here choose the inventory item. Once you choose the inventory item, QuickBooks tells you in the quantity on hand how many QuickBooks thinks that you have. If I say the new quantity is 0, then or 25, I have 25 on hand and the new quantity is 25. There's been no change in the quantity. Here I can either say the change in the quantity is -1, which now makes my new quantity 24 because I had inventory shrinkage, or perhaps I want to say the new quantity has a change of quantity of 3 and call that other income because I was given some inventory. So in the quantity change, it's either going to be a negative or a positive number, and then QuickBooks will do the math in the new quantity. So this is if you need to make inventory adjustments because you have the items in inventory and either need to say how you got more or say why you have less. Inventory adjustments does not override creating a bill or creating an expense or a check and adding inventory. If you're purchasing inventory, you will either create a bill, create an expense, or create a check to increase your inventory. This form is not for when you're purchasing inventory. It is for when you're trying to write off because of inventory shrinkage, or write off because you've given some out in advertising, or bringing some in because perhaps some way you got some inventory that you did not have to pay for. So that is how we do an inventory adjustment in QuickBooks.